right, so welcome back, guys. So today we are going to be taking a look at chapter 6.1 all the way to 6.3. And in this case, right, we're going to be diving right into periodic sales. Now, what happens when we make our sales, especially dealing with periodic inventory, okay? There is a special kind of journal that we have to do when it comes to making sales of periodic inventory. Okay, and that's what we're going to learn today and dive right in. Now, of course, right, we talked about the nature of the business, right? Our goal is to take our natural materials and resources to ultimately create a product or a service for our consumers, right? The main goal here is to ultimately sell a product and make a profit, okay? Okay, that's the point of doing business, is to generate revenue, okay? And by generating revenue, we need to also minimize all of our costs, right? So that's the idea here, where when we start creating our products, right, or in this case, we're not looking at a manufacturing perspective. We are looking at a retail perspective, where we already purchase pre-made goods from a manufacturing store or a wholesaler, right, depending who they are. We already buy pre-made products, okay, and we buy it at a cheaper price, okay. And what we're going to be doing here is that we're going to ultimately resell those objects, right? We add our own finishing touches to those items and ultimately turn it around and sell it out to the public as a good, all right? Now, in this case, right, so we purchase our items at cheap and then we sell it at a high price, which includes a profit. Now, as you know, selling goods, right, and services is the primarily goal of all businesses. So, to determine when we're doing a merchandising inventory, how do we determine what the selling price is? How do we determine how much money we want to make off of selling an item, okay? And that's where we're going to be creating what's called a cost of goods sold, right? We need to figure out the selling price, which is going to be calculating all the cost it takes to get your inventory item to the store, which we've been practicing, right? We know what that is. It's going to be every cost included to get the inventory item to your store, all right? And because when we deal with shipping and handling and other things such as sales tax, or in case you have to pay foreign fees or expedited shipping fees or handling, right? That's going to be tacked onto the cost of the actual item, because in this case, right, you never want to pocket out those expenses separately when you can have your customer pay for it. It's just going to be included in the cost of selling your product, okay? Now, when we talk about the cost of selling the product, right, the selling price is going to be based off of your cost of goods, so your cost that it takes you to sell that item, and including a profit percentage. How much money do you want to make off of reselling this item? Okay, so for example, right, we've been buying a lot of toys for $1 to $1.25 to $1.50 each, right? We can take that dollar because that's what it costs us to obtain those items, right? But in this case, we could turn it around and say we're going to sell it in our store for $5. So that calculates your total cost that it took you to purchase the items And it also includes the amount of profit that you want to earn based on selling that product. All right. So that's important because that is going to be what sales is, right? Our ultimate goal is we're trying to sell a product that we purchase, or in this case, because we're merchandising, we're trying to resell an item that we already purchased previously at a lower cost, and we're trying to sell it to be able to make a profit. Okay, you never want to sell your items at cost point, because then you're breaking even, and at that point, if your inventory cost is one cost of operating your business, what about all the other operating expenses that you have to incur in order to have your business, such as rent expense, right? You can't charge your customer money to cover for, you can't charge them as a fee for selling an item, right? You can't tack that on as a cost of the item, because that's not what it costs you to have for the item. You need to make sure you sell set a selling price that's able to not only cover the cost of the item, but also to help you also cover the cost of just doing business in general, right? Covering the cost of rent, okay, labor, making sure that you're able to pay other people, right? And of course, because we're looking at a merchandising store, we're going to be looking at being an actual physical store. So that means we are subject to have to charge sales tax. Okay, that is an obligation by the state, okay, and the local city that you do your business in. So in this case, the sales tax that we're going to be learning, I guess not learning, but using for this class is going to be 8.25%, okay? Now, of course, 8.25% right now, obviously, in the state of Nevada, it's, I believe it's I think it's 8.375 or something like that. Now, that, once again, when we talked about this in QuickBooks, right? In order to determine what a sales tax price is or how much to charge, the percentage is broken up based on the state that you're doing your business in, and it's also going to be the local city that you are doing business in as well. Okay, so again, the state will charge a certain percentage, and then the city/county that you belong into will also charge a separate tax as well. Okay, and that what makes up your whatever 8.2 or 9 point whatever city and state that you live in. In this case, for this class, I'm going to keep it real nice and simple. 8.25%. Okay, straightforward, simple. Okay. Right. So now let's talk about how we introduce periodic inventory sales. So in this case, on June 1st, right, 10 items were sold for at $9.99 each. Okay, sales tax was 8.25%. Record the sales. So this is assuming we already made our purchases of inventory. So now that we already did our purchase already, now we're dealing with how we sell those items. So in this case, we're going to be taking a look at two key factors, right? Sales and sales tax. Okay? Typically, these are the two accounts that you will only see, because when you sell a product, right, it's straightforward. You have sales. If you charge sales tax, right, which we talked about, it's a liability because it's money that you are charging your customers, but it's not money that you're going to be earning. That money's going to go towards the city and the state, right? The city and the state mandates everybody to charge sales tax for, to be able to operate the city. Okay? So that's money that isn't yours. That money belongs to the government. So in this case, right, we know that sales is what type? What type of account is sales? What type of an account is sales?
A credit.
It is a credit, but what account type?
An asset.
Sales is definitely not an asset. So in this case, sales is considered income because we are generating money, right? We're finding means of ways to generate revenue for our business. So in this case, it is an income or it's also a revenue. Okay, so you got that correct. Where now you understand, right? We're going to be increasing our revenue, so therefore we need it's a credit account. Correct. Now, depending on how you get paid, of course, right? Whether it's a cash sales or if someone owes you on an account, okay? That's what you're going to be increasing because you're going to be increasing your flow of money, right? You sold a product. Your assumption is you're going to be receiving cash, okay? So therefore, if you're going to receive cash for making a sale, therefore you're going to be debiting your cash and your accounts receivable, okay, depending on how it's calculated. So once again, we have sales. Sales is going to be what you've earned, all right? So in this case, if you sold 10 items at $9.99 each, right? That's going to be equal to $99.90, right? 10 times 990 gives you $99.90, okay? And then, of course, you have sales tax because you are obligated to charge sales tax. So we're going to take 8.25% and we're going to multiply that based on the overall amount of sales that you've generated. Okay, so in this case, we're going to multiply it based on the 99.90. Okay. So in this case, boom, $9.99 times 8.25% gives you a total of $8.24. So therefore, the total amount of cash that you are going to be receiving is $108.14. Okay? So remember, there's a huge difference between when you generate that revenue. Now, imagine you are in the store, okay? And you're the clerk, right, of the store, and someone gives you cash. They're not going to give you cash, right, separately. They're not going to give you for, oh, okay, the item that I bought is $9.99, so here's $10 for that, and then here's $10 for change. They're not going to do that. They're just going to give you a lump sum money. But it is your responsibility as a business to keep track of the sales, so the amount of generated income that you actually earned, that's actually your money, and also the money that you owe the government, because once again, sales tax that's included isn't something that you charge for your personal profits. You already include that in the selling price. You're just obligated for doing business to charge sales tax. So in this case, you, in your books, you must record it as two separate transactions, right? A portion of the money belongs to the government, and the other portion is your money alone. So then you're going to get a total right here of 108.14, okay? And that's your total sales, okay? Or instead, this is your total cash that you'll be receiving, right? Any questions? I'm assuming that's a no.
No.
Okay.
No.
All right. So, under periodic inventory, right? Since the definition of periodic inventory is that we do not care or we do not recognize, or in this case, we don't keep track of our inventory until we go down to the basement and take a physical count, right? So our assumption is that if we don't keep track of our inventory so often, that means every time we sell a product, we don't care to record or to update our inventory because it doesn't matter at the end, because when we at the end of a given period, at the end of the day, our assumption is that if we started out with X amount, right? And at the end of the day, we go down and take a physical account and we only have X amount left, our assumption is that we must have sold the rest of the stuff. All right? And that's the idea here. In this case, we only need to record the sale and the sale only. We don't need to record that we're taking inventory items out or we're recognizing that we sold X amount of items, okay? In this case, no. We do not count how many items we're selling here, okay? Because the idea is that it's periodic inventory, so we will find out at the end of the given period of how much items we sold by doing that assumption, where if we had 10 items and we sold 4 of them, then and we have 6 of them left, then our assumption is that we sold 4. Okay? And that is it for chapter 6.1. Okay? All right, so now 6.2, periodic sales returns and allowances. Of course, if we have the idea where we sell our products to our customers, that means we are subject to sales returns and allowances, okay? So, just like any other store out there, right? If you purchase something, there's always going to be some group of customers who will have who will want to return our product, okay? Because there are many reasons why a person would return a product. Okay, it could be that they brought it home and the item is broken, or it could be defective. Other things could be that they simply just don't want it anymore, or someone purchased them as a gift and they don't like it, right? They can come into the store and be like, I don't like this gift, I want a return, right? Or they can simply just be unsatisfied with the product, right? That's the thing about being a store, is that you're trying to sell a product to gear towards our specific person. And if they try it on and they don't like it, and they come back to your store and say, I don't like this product, I'm unhappy with it, then they can go ahead and you'll have those customers who return products to you, okay? Now again, you as a company must set parameters or must set guidelines on when you can return, because the ultimate goal of a business is to ultimately sell your goods, right? And you want to keep your items sold. You never want to have unlimited returns and allowances, because then at the end of the day, there are some customers out there that take advantage of that. They buy the product from you, they use it until the day is coming up, and they said, you know what, I want my money back so I can go buy another product with it. They'll come to your store, they'll return the product, they get the cash back, and they'll take that money and buy something else. Okay? And unfortunately, there are some customers who are like that. Okay? And that is exactly why we must prevent our customers from doing so by setting up some company policies, especially good ones would be, limiting the amount of days or the window that you can return a product in. So oftentimes, a lot of stores, on the bottom of the printed receipt or the back of it, usually it tells you how many days that you normally can be able to return a product. So usually it could be 14 days, 15 days, 2 weeks, 30 days, or things like QVC. They allow you to use the product all the way up to anywhere from, I believe, 90 days is the last day that you can return it. Okay? So in situations like that, right, that's their company policy. Now, in this case, we want to make sure that we keep our items sold. So we don't have to limit by having a window of opportunity to return items, right? We can go as far as offering store credit, okay? So say, oh, sorry, there's no returns, but you know what? We can allow you to return the item and give you store credit. So therefore, you're forcing the customer to still buy something from your store, okay? Because you're offering store credit. You can't use store credit anywhere else. It's only within that store. So you're forcing the customer to stay within your store so they can buy a product and it will stay sold, right? Other things could be final sale, so no returns. So sorry, no returns, no ifs, ands, or buts. Once the item is sold, it's done for you, no returns. Other ones could be you can even issue a new product, right? Amazon does this all the time. You never receive your product, okay, that's fine. We'll ship you another one, okay? Or if the item is broken, it's okay. We'll ship you another one, okay? Other ones could be even exchanges. So those ones are more common too. You can come to the store, and if you don't like this product, well, you can purchase another one and do a full exchange. Okay. And yes. Now, of course, if you're going to offer these return policies, you do have to know that if you do return a product to the store, right, and you charge your customer sales tax, therefore, you need to also give back their sales tax, because ultimately, once again, that money's not yours, okay? It belongs to the government. And if they return an item to you, you need to return their money back because, again, they're not contributing to society anymore. They're refunding the product. So therefore, you are obligated to refund the amount of money, the whole entire amount with the sales tax included, to the customer. Okay, they're not going to come to your store, buy something, and expect them to donate the money to the government. No, that's not how sales tax works. Right. So again, sales tax is refundable. You are obligated to return the sales tax. So let's go ahead and dive into the exercise right here, where we're going to practice the sales again. So in this case, right, on May 1st, you sold 50 coffee mugs, okay, for $5 each, okay? And sales tax, once again, is 8.25%. And customer A, okay, decides to pay you with cash for the mugs, okay? So let's go ahead and record this transaction, okay? So we sold 50 mugs to customer A for $5 each. So what is your total amount of sales? $250, right? Now, in this case, we also have to charge sales tax too, right? The sales tax is going to be based on the total amount, not the items, okay? It's not based on 50 items. It's based on the total amount that you charge the customer. So in this case, you're going to charge the tax based on the $250, okay? How much tax is going to be charged? How much are you going to collect from your customer?
$20.62.
$20.62. I think it's 62 and a half, so you might have to round up. So in this case, you always round up when it comes to the government. Okay. So there it is. We take $250, we multiply it by the 8.25%, and you should get $20.63. So that means in grand total, you should be receiving from customer A a total of $270.63. Right? In grand total. But you've only earned $250. The other remaining amount is what you owe the government. Okay? Okay, good? Everyone is okay with this? So now, let's talk about our first returns and allowances example here. Okay, so here on May 10th, customer A wants to return 10 of those mugs for a full refund. So maybe customer A didn't need all 50 cups, okay? They only needed 40. So they end up coming back to the store and say, hey, I don't need these 10 extra cups and I want a full refund, okay? And of course, your company's return policy was a full refund within 15 days. So in this case, they bought it on May 1st. It's May 10th. They made the return policy window. So therefore, let's go ahead and record this transaction. Okay? So customer A, right? They paid us with cash. Okay? And in this case, we charged each cup $5 each, right? So if they're trying to return 10 of those mugs, how much money are we going to be giving back to them? Okay. We're trying to return, or customer A wants a full refund, and they're trying to return 10 of those coffee mugs, which we originally charged $5 for each.
$50.
$50 is what we're going to return to them. But we also have to include the tax because they paid the tax. How much tax are we going to charge them?
$4.125.
Good, okay? Good. So first thing we're going to recognize is because we need to recognize a contra account called sales returns and allowances, right? This is where we're going to learn that sales, right, is going to be finite. It's going to be, you can't reverse sales, okay? So in this case, in order to undo sales, we need to create a contra account and call it sales returns and allowances, right? And because sales is normally increased with a credit, right? Contra accounts flow in the opposite direction. So therefore, my contra account is going to be on the debit side, right? We determined that because we sold the product, right, was 10 mugs at $5 each, we're going to determine that the sales returns and allowances is going to be for $50, right? Now, in this case, right, sales tax is going to be based off of the amount that you have sold. And in this case, if I'm refunding $50, that means I need to calculate the tax percentage on those $50 to give them back their tax, which in this case, right, 50 times 8.25% is going to give you $4, and I think it's 125, which we're going to round it to 13 cents. So therefore, since customer A paid us with cash, we're going to give them $54.13 back. Okay. Any questions here?
No.
Okay. Straightforward, right? You buy a product, then you return it. This is exactly what you're going to do. You're going to basically kind of reverse the transaction, except use a contra account. You're going to give back the sales tax, and lastly, you're going to give them back for whatever they paid you on, whether it's cash or on an account. Okay. Right. All right. So the next scenario we're going to be taking a look is going to be called an allowance. Now, as a small store, okay, you actually have a little capabilities that you can do versus a corporation, okay? You have the ability to haggle your prices, okay? So, because as a small business owner, a small store, you're not technically saying like this is the price unit for it, or this is what you can haggle, right? You can always like put perks or anything like that, because your ultimate goal is you want to make sure that you keep your customers happy. So with this one, we're going to call this an allowance, where if a customer comes in unsatisfied, we're going to give special offers to the customer so they can be satisfied with the service, right? So in this case, right, on May 18, customer A wants to return 10 coffee mugs for a full refund, okay? And the customer doesn't like the color, okay? And then you tell the customer that they have missed the discount period, okay? I'm sorry, excuse me. The return policy. So therefore, you offer them an additional 15% because they missed the return policy, right? And they're probably in their store, they're yelling at you and stuff like that, saying, well, no, I'm not happy with this product. I demand a full refund. I don't care what your company policy is, right? You definitely don't want to lose them as a customer right away, right? You definitely, because like, again, if you're a small business, any kind of customer is a good customer. So you want to make sure that you keep them coming back to your store. So you kindly offer them a 15% discount for, to reprimand the mistake, or to reprimand, in this case, not a mistake, but in this case, you want to keep them satisfied. Okay, you know what? How about this? I give you a 15% discount, right? And of course, they're willing to accept. So let's go ahead and record this, okay? Now, here, notice this. Sales returns and allowances, okay? In this case, did the customer return the product?
I mean, 50% discount on what? On what he buy, or just 50% on what he's gonna buy? What's the case here? I don't understand.
So in this case, he's trying to return 50 mugs.
But he cannot.
But no, we cannot because he missed the period. So in this case, we can only give him a discount off of the 50 items he's returning. You can't just give a random discount to all the items, right? Because they purchased it on the 1st of May. They come back to your store 18 days later saying, hey, well, I'm not satisfied with this product. And they come back with you with only 10 cups in their hands. You can't discount them for the whole amount, because what if you don't have records of customer A? What if you don't know customer A because they paid you in cash? They are a simple cash customer to you. You don't have records on hand, on file. So in this case, would you know that you sold 50 items from them?
Yes, but you don't gonna return. My point, I don't understand. You don't gonna return absolutely anything because you cannot return. So you're gonna give him 50% of what he buy, just like that, a cash, a credit store, or what you doing here? I don't understand what you do.
Yes. We're going to give him 15% discount. off of what he already purchased. So yes,
Just
we're
like
getting,
that, you take from the register 50%, or sorry, the amount that is 50%, and you give it to him just like that.
yes, because as a small business, you want to keep his company. You want to keep him coming back to your store because he could be your only customer.
Okay.
So, like, that's why I said as a small company, you have more leniency. You can haggle your prices. Whereas a corporation, nope, set price is set price. But corporations, because they don't care if you come back and use the product and return it, they're going to give you unlimited returns no matter what because they don't want to sit there and argue with you. They said customer satisfaction is their number one priority. So they'll let you go in and return whatever you want. Even if you didn't even buy the product at the store, they'll return it. Yeah, like if you accidentally bought something at Walmart and you go to Target and they had to sell the exact product, they'll return it for you. Okay, and that's the thing about corporations, and that's the huge difference between corporations and a small shop. A small shop owner, right? You know, you're limited on funds, you're limited on your inventory items. You want to keep everybody to make sure that they sell and buy your product. So in this case, yes, we are going to go open up the cash register and give them their 15% back, cash back, because they've already paid for it. They're coming to you trying to return the product, but you said no. And then, again, they're making commotion and you want to try to keep them to come back to your store. So you kindly offered them a 15% discount. Okay? So in this case, right, did they return the items to you? No, because, again, we said no. You can't give back the products, right? You already bought it. Okay, so that means they're keeping the products. However, because they're being unsatisfied about it, right, you offer them a 15% discount. Okay. Right? So in this case, right, we're gonna give him a 15% discount. So, but it can't be on the total amount of items that he bought because we didn't know when this customer A came in the store, right? We see on their receipt that they purchased 50 mugs, right? However, they're satisfied with the 40 mugs that they have. So in this case, we can't refund for the whole amount. We can only refund for the items they're attempting to return. So hence, that's why it's called returns and allowances, because we are not giving him a full refund, but we're giving a portion of the refund back, which we call that as an allowance. Okay. So again, often a lot of stores will give them like a coupon to come back to the store. That's also considered an allowance. Okay, or a rain check. But in this case, right? Excuse me. We're looking at giving them a 15% discount on the items that they've already purchased. So in this case, we're refunding a portion of the money back. So in this case, right, that's why the idea of sales returns and sales allowances, right, they act as the same thing because at the end of the day, you're still giving the money back. They're both contra accounts to sales, right? It's reducing the sales. So I just, in this case, for this class, I just crammed them together. They can be separate, they can be together. In this case, they function the same way. So instead of teaching you two separate ones, I'm just going to make them into one. So sales returns and allowances is what you're going to recognize because they're attempting to return the product to you, but you're giving them a portion of the money back. You're not giving them a full refund. You're only giving them a percentage of that money back. So that's the allowance part of the sales returns. Okay? Again, because we're giving them a portion of the money back, that in perspective means that they didn't pay for the product in entirely, right? We charged them $5, but in this case, we discounted those items, right, by 15%. So therefore, we have to give them back a portion of the tax because that because when we sold the product to them, we sold it to them less because we're giving back them their money for the discount. So in this case, we sold the product to them at a discounted rate. So therefore, we need to give them back a portion of their money, of their tax back as well. And of course, since customer A paid in cash, it would say on the receipt, then we give them back the cash, okay? So in this case, we're going to actually calculate this, right? If they're trying to attempt to return 10 of those mugs, right, for a full refund, which we originally charged $5 each. So therefore, you got $50 worth of potential. Like that's the amount that that they want you to refund. But you're telling them that I'm only giving you 15% of it back. So therefore, you need to calculate whatever $50 is times the 15%, and that will be your total amount that of the sales returns and allowances. So in this case, I figured that 10 times 5 is 50. 15% of $50 will be a total of $7.50. Okay, and again, because because that was the amount that we gave back to them, right? Which means we discounted each cup 15%. So therefore, we need to calculate how much tax money we have to give back. And in this case, right, if we're returning $7.50, then we need to calculate the tax based off of the $7.50, which we do to get a total of 62 cents back, right? And then, of course, we give back 62 cents. Therefore, in grand total, I'm going to be giving the customer back $8.12, okay, for the 15% discount that we're giving them based on those 10 mugs that we originally sold them for. Okay, so we originally sold the 50 mugs at $5 each. So we're discounting the $5 to fit by 15%. All right, and then we're going to go ahead and give that money back because we already charged them. Now we're giving it back. Okay, so in this case, the customer will get $8.12 back. Okay, good.
Yes.
So that was it for 6.2. All right. Now let's go ahead and dive right into 6.3.
Can I ask if you calculate from the amount $54 point 13, you take the 15%, you're gonna have the same amount. You cannot calculate from there. No, doesn't go.
Well, in this case, you still have to separate it because a portion of the money is what you actually earned, and a portion of the money is what the government gives you, is what you owe the government. So, if you took the receipt and you just calculated, yeah, that's correct. You get the same amount. That's right. But at the end of the day, in your books, you need to show that you're taking money out from your profits, and you're also taking money about the government that you owe the government. So in this case, you need to separate it because that whole entire amount you did not earn. A portion of it belongs to sales tax.
Okay, thanks.
Okay. So 6.3. So of course, if you're going to have sales, right, you must be able to also have discounts. Okay, so let's take a look at sales discounts. Right? Oftentimes, you will always see a store offering some kind of discounts that are going to be able to be applied, whether it's a store-wide, online sale, or just on a specific item in the store, okay? Now, again, this is for promotional tactics, but again, if we understand how society works, right? Customers are not willing to pay for a product at full price. And we all know that, right? Everybody's looking for any way to save money. And that's what the society that we live in, right? If you put a price out there at full price, some people will look at it. They might not buy it because it might be out of their budget. But until the day that you put up the sign that you have a discount on that, a sales discount that day, right? 40% off sales, or 50% off, whatever percentage that you do, you take off, right? People are more likely to be willing to buy it. Okay? So that's the idea here, is that you're more likely to sell your products more often if you have a sale. Okay? Because again, not many customers are going to buy a product at full price. They'd rather buy it at a discounted price. Okay? Now let's talk about this discount. Now, oftentimes, this is where you have to be aware, okay? Your discount is not going to be on how much it costs you to sell the product. The discount is based off of how much of the profit that you're going to be taking off, okay? So, for example, we established that we purchased some of the items, right, in the periodic inventory. We purchase toys at $1 and we sell them at $5 each, right? If that's the case, then your discount, if you say 40% off, right, you're still receiving some kind of percentage of profit, but you're never going to do a discount where you are dropping below cost. Okay, therefore that means you're going to be pocketing a lot of this stuff, and you definitely can't do that because of the idea of that you have more than buying inventory as an expense. You have to be able to turn the lights on in the store. You have to be able to pay the rent. So you can't afford to take crazy discounts off of your products. However, that is what the discount is based off of. It's basing off of taking a discount off of the actual profit percentage that you're trying to get from selling a product. Okay, so again, oftentimes that you'll normally see these sales will be any promotional sales, any grand opening sales, or just store ride sales, or even online sales, online deals. Now, oftentimes, many grocery stores, they'll have like an item of the week or weekly ads where you have specific products that are on sale. So again, not everybody's willing to pay full price for a product, but if it's on sale, you're most likely to see all your products go a lot quicker. Okay? So once again, not only is it an advertising some kind of tactic way, but it's also to help you also get rid of your inventory, because in the next section, we're going to talk about lower cost of market. What happens when you buy inventory and it never gets sold? Eventually, with time, right, those inventory items that you purchase will eventually lose value over time. And we'll talk more examples of that. So with that idea, right, you can't be holding onto inventory forever. So you need to sell your products and get them out of your inventory as soon as possible, okay? Because you definitely don't want to take a loss for that. So in this case, the sales is the best way to go ahead and sell all out your products in a quicker manner and help you clean up your inventory, right? So again, other discounts can also be, so if vendors, right, we talked about how vendors can give us terms. As us as a store, we can also offer our customers discounts as well by saying, hey, if you can pay me back in time, I'll go ahead and give you a discount off of that. So terms, once again, applies to both vendor and customer, okay? All right, and we're going to take a look at examples today, examples in the next couple slides. So first example here is going to be a sales discount, right? And this one's going to be an in-store sale. So this example here is on June 1st. Your store is having a promotion on all items are 40% off, okay? And a customer decides to buy 10 baseball hats with cash, okay? Which original price for it is going to be $10 each, okay? Sales tax, once again, is 8.25%. Now let's go ahead and record this transaction, okay? So here we have to think we're going to be recording the sales, right? So this customer decides to buy all of our products with cash, okay? And because our store has set prices, right? That's how we determine the percentage of discount, right? If the percentage of discount, right, we need to know what the original price is in order to determine what that discount is. So in this case, right, sales discount is once again another contra account because it lowers the original selling price, right? It lowers the original sales by taking a portion of that profit that you're supposed to earn and decreasing it. Okay? So in this case, right, if we sold 10 hats, right, and they were originally priced at $10 each, right, and the store had a 40% discount, how much is the discount for? Okay, let's do this again. You sold 10 baseball hats at $10 each. Okay? Your store has a sale where it is 40% off of the original selling price. Okay? So therefore, what is the amount of discount that you're going to be having?
$40.
$40, okay? All right? So in this case, right, if you ever looked at your receipt, right, when you go to the store and you buy things that are on sale, if you notice on your receipt, you're going to see that you're going to get charged for the original price, right? And then down below it is a line item for the discount that subtracts the discounted amount. So in this case, that's exactly what we're going to do here, okay? So in this case, we're going to recognize cash, sales discount, sales, and sales tax, right? Because in this case, right, we need to recognize that we're going to be receiving money, right? We need to recognize that there's a discount going on. We need to recognize what the original sales is. And of course, we have to charge tax based on that, right? So again, the original sales, right? 10 times $10 gives you $100, okay? And then we charge we take the discount of $40, right? Because that's 40% of $100 gives you $40 discount, okay? Now that means you're left with $60 left that you're supposed to be receiving. Here, this is where you also need to charge the sales tax. Now, sales tax, once again, is going to be based on the total amount that you sell. In this case, did we sell $100 worth of stuff?
No.
No, we only sold $60, right? So that's where you're going to have to calculate separately that you can only charge tax on $60 instead of the full $100. Because in this case, the person walked out of the store buying the items for $60, not $100. They bought it for $60. So therefore, that's the amount of tax you're going to be charging on. So 8.25% of $60 is going to give you $4.95. So then the amount of cash you're going to be receiving is $64.95. Okay? And this is what your journal is going to look like. Okay? Any questions here? No?
No.
Okay. Good. So that's what we do when it's an in-store sales, right? When we recognize a sales going on, we need to separate a line item for that discount, but we also need to recognize what the original amount was. Okay. So then let's go ahead and take a look at another scenario where we are making purchases we're making sales, okay, of someone purchasing in bulk on an account, okay? So here on July 1st, okay, a customer wants to buy in bulk 100 baseball hats from your store on an account, okay? And because this customer is a first-time buyer, okay, you're gonna offer them terms in which is going to be 5%, 15, net 30. Okay, so because they're a first-time buyer and they decided to open an account with you, you said, you know what? Since it's your first time opening an account with us, we'll go ahead and throw in some terms. So if you do pay us within 15 days, you get to take a 5% discount. Okay, so that means, again, terms is going to be individually based, right? It's not something that you give to everybody. Okay, so this is where 5%, 15, net 30. Now, again, maybe you do this for all of your first-time buyers, so that could be possible. Okay, so then at the end of the day, okay, each hat was sold for $10 each. Okay, sales tax was 8.25%, and because you decided to offer them to ship out all 100 hats to the person, right? Because maybe you didn't have all 100 in store, so you said, hey, I can deliver it to you. Okay, so you're gonna charge them $10 delivery. Okay, so let's go ahead and record this transaction. So here's a few key notes. You charged them for the sales, right? But they placed it on an account. So therefore, this is where they owe you money. So we're going to be introducing you to accounts receivable. Okay? Sales. Now they bought 100 baseball hats for $10 each. So that right there is $1,000. Okay? The tax is going to be once again charged based on the total amount of items that you sold. So in this case, it's going to be based on $1,000. Okay, so that should give you $82.50. And last but not least, you're going to tack on the $10 of delivery fee. So again, delivery charges is something that you can't tax because it's a separate service. It's not selling a product. You're not selling delivery. It's a separate charge. So in this case, delivery charges are going to be after your taxes. Okay. So if that's the case, then my total amount that I racked up was going to be, or I billed this customer, is going to be $1,092.50. So again, we sold 100 baseball hats at $10 each to give us $1,000. Based on the sale of $1,000, we charged the tax of $82.50. And then we tacked on an additional charge for shipping and handling of $10. Okay. Now here, this is placed on an account. We gave them terms. Terms is a condition. The customer must pay within a certain amount of days in order to get the discount. If not, They just owe us a regular amount within 30 days. So in this case, this discount is going to be based on whether they make a payment or not. There's conditions with that discount. So they cannot receive the discount right away because the condition is they must pay. Okay. So here is this example here where then 12 days later, right? It's July 12th, and they decided that they're going to pay for their purchases in full. So let's go ahead and record this discount, especially when terms was 5%, 15, net 30. They paid within terms, right? We gave them 15 days. They paid within the 12th day, right? They purchased it on the 1st. It fast forward 12 days later, they're going to pay. So that means they get to receive the 5% discount, okay? So in this case, right, how would we record this transaction? Okay. So in this case, right, we already record the sale. So the sale is done, right? Now we're only looking at what they owe me, okay? In this case, we're going to record that the fact that they're paying off what they owe me, right? We should be receiving cash, okay? And because they're getting a discount, that's going to be there, right? We're going to recognize their discount. And because they're going to receive a discount, because we already charged them for their sales tax, we have to reverse that and give them back a portion of their money because we originally charged them sales tax. Okay? So in this case, right, you can only you can only take a discount off of the original selling price, right? You cannot discount tax. You cannot discount shipping and handling. You cannot discount any of those items. So therefore, you need to calculate what the original sales was $1,000, right? Because 10 times 10 is $1,000. I'm sorry, 100 times 10 is $1,000. You're going to take your 5% discount, which in grand total was $50. Okay? Now, if you're discounting the items, right, which is the original selling price, by 5%, therefore, the customer purchased it at a discounted amount. So therefore, we need to calculate how much tax we have to give back because we charged them for the full amount. In this case, we know that it's you're going to take your $50 and you're going to multiply by the 8.25% to get $4.13. Okay? And once again, we know exactly how much they owe me because we already recorded it in the first place, right? So therefore, we figure out how much that the person is going to pay me. So in this case, they're going to pay me less because they paid within terms. So they are granted that 5% discount. Okay, so you can take the $10.92.50, subtract the $54.13 to get a total of $10.38.37. Okay, and that's how you give discounts when things are placed on an account. Okay, any questions here?
Nope.
Okay, so once again, course review here. We have how to record a sale, whether it's cash or on an account, right? We also recognize what happens when a customer returns, right? And we also looked at when a customer gets an allowance. We also took a look at what happens when we have in-store discounts versus offering terms, okay? So what I'm going to have you guys do is let's go ahead and take our quick 20-minute break now. Come back and finish the rest of the exercise, and then we'll call it a day, okay? So right now it is 2 2:40. So take your 20-minute break and please be back no later than 3 o'clock.